and welcome to the Build and Exit podcast. I'm Julie Wilkinson, and I started the podcast off the back of the work we do in my company, Wilkinson Accounting Solutions, because I realised there was a lot of gap in the UK market in terms of financial education, especially when it looks at exit planning and acquisitions. So I'm really excited today to have Jamil Anakkar with us. Hi, Jamil.
How are you doing?
Yeah, good. Thank you. Are you?
Good. Very well. Thank you.
Just a bit of background about why we've asked Jamil to come on the podcast. So a bit of background. So Jamil had a job. He was a partner in a company, and in 24 has ventured off to become the CEO of Tandy Ventures, and that's what we're going to be talking about today. This is his acquisition journey, which is actually done quite quickly and looking to get into build an 80 million group next year. So I think it's going to be a very interesting intake for buyers, but also people that, you know, are looking for an exit journey, and maybe they can hear some of the things that you're looking at doing, because people can take some inspiration from it. So first of all, I just want to hand over to you, Jamil, and so you can tell a bit about yourself and why you wanted to come on the podcast.
Absolutely. Yeah. Well, thanks for having me. It's always great to, be speaking with people and in circles of people that are looking at either buying and building or going into M&A in the small business world. So for me, I was made aware of the M&A world through my consulting career. So as you touched on a moment ago, I was a partner in a management consultancy firm in London. Prior to that, I was at Accenture for a number of years, worked globally in strategy consulting. Prior to that, paramedic. So bit of a different jump there. I had always worked in the health sort of industry as a sort of client base. And towards the last kind of 5 years of my career, started working with private equity, investment banks, large corporates, working on growth strategy, working on M&A due diligence. So that's where I really started to learn about the world of M&A, but more specific to this, how that can be related to small businesses and how you can actually go and do roll-ups and M&A in the small business world. So I really started to kind of like study that and just figure out how you could take what happens in big M&A deals and apply it to the small business world. So what got me really excited about going and doing that was understanding the size of the opportunity. So the wealth transfer from baby boomers down to other generations over the next few years, it's in the trillions globally. I mean, it's in the trillions even in Europe, meaning people that are retiring and have businesses with no succession plan, or they don't understand how to sell it, or it might not even be able to be sold because of how it's ran and things like that. So the opportunity is massive to be able to look at taking over businesses from people that are retiring, ill health, they don't want to do it anymore, whatever the circumstances are. So when I started to see examples of this from people that had actually done buy and builds in the small business world, buying companies that are kind of below the threshold of interest for private equity, building them into groups where they are the size that they're of interest to private equity, and then selling them, and looking at some of the multiples and just how quickly some of that can be done. That's what got me really excited. So as you mentioned, I left my corporate job in May this year. In the background to that, I'd already started target screening and planning and putting together my strategy for how I was going to approach this. So I was able to get a deal to heads of terms prior to leaving my corporate job. So I left my corporate job in May this year, and we completed early July, I think it was, on my first acquisition. But what I haven't covered there is the volume that I had to get through when target screening. It wasn't one and done. It was very much a case of contacting thousands of businesses in the industries I was looking at to get probably around a 1% response rate on average, I would say. Did reach heads of terms on a couple, one that I pulled out of, and then the other that we took forward and did the deal with. I found that it was genuinely easier to do bigger deals. So initially I went into it and thought, right, I'm going to look for businesses in the fire safety sector because that's what I decided I wanted to buy and build in. And I'm going to focus on businesses that kind of have a revenue between 500,000 a year and 5 million a year, because I kind of thought, well, I can understand those businesses and I can financed them relatively straightforwardly. What I then found is it was actually easier to do deals with businesses that are at the higher end of that, and very difficult to do businesses with an EBITDA less than around 500,000, let alone a revenue 500,000. So the deal I managed to do, my first acquisition in July, that business had a revenue of 4.5 million, had about 20% EBITDA margin, and that's been the first in the group. So some of the key learnings from that really are bigger deals generally easier. There's more money to play with. There's a more margin of safety to play with if the business is well run. They normally have a good general management structure in place, or if they don't, the business can afford to bring in a general management structure to support an exiting owner. Best businesses that I look for are those that the owner is kind of hands off. So they spend most of their time semi-retired, doing whatever else, on the golf course, whatever it may be, so that they've already made that transition of leaving the business and the general management team deal with the day-to-day. Because what I don't want to do is create a job for myself taking that company over. So in a nutshell, that's what's led me to here.
And that's interesting. So out of all the ones you looked at, I mean, how many would you say realistically that you think the owner's at that place, like off the golf course, retired? How many would you say you see?
It was definitely more common in bigger businesses. So companies with a revenue, let's say over 3 million, where they've probably got to the stage of wanting to semi-retire and eventually retire. They've maybe dabbled in trying to sell it, but they're kind of price sensitive and the sort of person that would wait for the best offer to come through rather than just actively try and sell it as quick as they can. So not many, truth be told, especially the small businesses that are owner operator, which I have now decided I just will never look at again. It's just not worth the time. It's so much easier to look at businesses where they've already exited operationally, or they just are 1 or 2 days a week in the business and they have managers in place, that run the business day to day. It makes things so much easier in the handover. And like I said, it means I'm not creating a job for myself taking that company over. And it also means we're not having to increase the payroll by having to hire a new manager in where there wasn't one there before.
Yeah. No, yeah, definitely. I was interested because it's interesting you say, because I've seen quite a lot of businesses, well, sort of in the tens of million, more like 10 and 15 million, where the owners and the CEO aren't actually, they are still involved. And what I also find is, even if they're not as involved, because we're doing quite a lot of acquisitions at the minute, so I see quite a lot of different sizes, we find that they'll have like a CEO or an MD or maybe something that's working for them, but that person's maybe doing the equivalent of two persons role because they're doing maybe like 60 hours a week or something like that. And we're saying obviously can cause a problem because it might be realistically they're just lucky they've got a dedicated person more than the fact that the business is still being run effectively, if you know what I mean.
Yeah.
All right, so you did your heads to toes. I know your deal actually closed relatively quickly because I think it was around 6 months, was it? You said between finding it, getting to heads of terms, and closing.
Yeah. So the first deal we met in January 2024. Heads of terms were signed and agreed in February. There was a bit of delay then. We were hoping to get the deal done in 4 months, but there was a bit of delay, and it was mainly because the deal structure changed. So I was initially looking at using an element of finance and then deferring the rest over 5 years, and also using some of the cash in bank. So the initial consideration was going to be cash in bank plus a bit of finance, the remainder deferred over 5 years. The deal was going back and forward. I think the owner was a little bit uncertain as to whether they, first of all, did actually want to sell. And secondly, they didn't really like the idea of the finance because obviously it's going to be the target paying it. And this was pre-interest rate cuts. So some of the fees being charged for invoice finance and for asset finance were quite steep. So they're quite frugal people. So we then actually changed it completely. So the deal structure ended up being the majority of the initial consideration was cash in bank on day one. There was a 5-figure amount I put in personally. The remainder, which was around 50% of the deal value, deferred over 5 years, which started after 90 days. So we had a 90-day kind of breathing, cooling off period, if you like, between completion and paying the deferred. And they also retained 15% of business equity. So the reason being, we were trying to bridge the gap, and it was on the initial consideration, and it was either going to be a case of, I need to go and get finance for this, or I'm going to have to put my hand in my own pocket and, use more of my own personal finance, because there was a gap. And then when I worked it out, I said, well, look, it's around 15% of the value of the business. So why don't we look at doing that? You retain that equity, different share class. But if we sell this, in 5 years' time, twice the size to what it is now, you're going to have a second bite of the apple. He's still quite active in the business in terms of winning work and things like that. So it's worked out quite well. But yeah, we completed in early July. There was a number of things personally that kind of slowed it down as well. I mean, there were people having holidays. The vendors sadly had a couple of funerals. There was all sorts of things. In the nicest possible way, this was the first time they had done anything like this. They are not the most commercially savvy people. And I think the level of business acumen you need to have to do this and understand it was on a different level to kind of where they were. So they spent hours and hours with their accountant and solicitor. They didn't understand anything in the SPA. It was all new to them. They couldn't get their head around the deal structure. So there was a lot of hand-holding, and ultimately that just slowed things right down. By comparison, so that was 6 months. By comparison, I've got a deal that's 10 days from completion now, my second. We had met about a year ago, but put it on ice because I had this deal going, the first deal going on. We got back in contact in, I think it was September. We had a deal agreed that week. Heads of terms signed the following day. And we're now due to complete on the 11th of November. So it's rapid. That has happened rapidly. There was one version of the SPA, whereas previously there were multiple versions of the SPA. Because I think the key lesson there is try and agree as much as you can with them, with the seller, before you get your solicitors involved. Because if you get your solicitors involved to argue over, is it a 90-day handover period or a 60-day handover period? What are we classing as assets on the balance sheet? What are we not classing as assets on the balance sheet? All that type of stuff, I've learned now, is better discussed and agreed between the buyer and the seller. You then take your heads of terms to the solicitor and go, here's our blueprint for the deal. Translate this into the SPA. They then obviously provide all that legal advice to you around protections and warranties, indemnities, all that good stuff. But the commercial part of the deal, you've already agreed. Because if you then start communicating to your solicitor, they communicate to their solicitor communicates to them. You've started this massively long-winded Chinese whispering process that goes on that slows things right down. So even now, if something comes up and I need to kind of negotiate with the other side, I'll just pick the phone up to the vendors and have a conversation with them first and just say, we had it yesterday. We had to increase the amount of working cash that we need left in the business when we take it over. Not by much, £10,000. But again, I didn't want them hearing that for the first time from their solicitor. So I literally just rang him and said, look, we've done our financial due diligence. Your monthly working capital is actually 10 grand higher than what you're saying it is. So we need you to leave an extra 10 grand in the bank on completion. Done. They accepted that. So I can then feed that back to my solicitors. And it just makes it a lot more harmonious than when you're trying to do everything through solicitors. And ultimately, then adding 2 other people into the process that also have holidays, annual leave, other things going on. So you just slow it right down.
Yeah. And I always say this because one of the things that we do at Wilkes where we help people do is we speak to the sellers quite a bit, because I do quite a lot of strategy sessions for deals, especially when people are moving to heads. And I do think the biggest problem on acquisitions is when people are rushing through heads, because they think if they rush through heads, they'll get the deal. And what they kind of do is they do handshake agreements without real insight into the commercials and the valuation. And then things move. And no one's got, the buyer doesn't really have the commercial acumen. and the seller doesn't know the commercials of the business, and you kind of get to a bottleneck scenario where they just think they're being done from deals. But if you can explain the risks at the beginning, because I've seen it on my deals and other deals, is, you know, sometimes you'll get the financials for heads and they'll be quite poor, because I do just think generally in the UK, the management of finances is typically quite poor. It is at year end, so it's hard to get information in the year. But that's fine, as long as you can identify the big risks at the heads of terms. You can put those clauses in the warranties, so that the seller's aware. If this and this materialises, or this comes off in due diligence, then it's going to drop the value, or it's going to change the balance sheet, or I need more cash left in the bank. As long as you have those conversations, then when that happens in SPA, you're not changing the deal. You've told them at the heads, and they're aware of the issues, so that then you can move the deal. The problem of the deals moving only becomes an issue when, you know, they just think, oh, well, they've moved it. And I've seen deals moved by over 4 million because of, just because of like a misunderstanding of like interpretation of accounts and where things were recorded, and what's the adjusted EBITDA, and then unreconciled items on the balance sheet, so that they don't, so the prior year's accounts were misstated, so their valuations overstated and things like that. We see those sorts of things all the time.
Yeah, I mean, especially in certain industries where the accounting can be a little bit tricky. So in the fire safety sector that my first buy and build group is in, a lot of it is construction. So it's CIS, it's retentions, it's all that type of stuff. And some people show it on as stock on their accounts, some people don't. It's quite difficult to understand a debtor position, because, you know, this client is holding back 5% for the next 10 months. And, you know, they've invoiced this and we need to make an application to get this invoice paid. So it's not very clear cut. And if you were going into an industry like that, where that's the landscape of invoicing, it can be very difficult to kind of get a clear picture of what the financial health of the business is, really, until you start proper due diligence. So I think getting as much financial information on the business as you can in that, as the head stage, as you've said, so you can understand the business and the financial landscape of the business as much as possible. Because, and I've had it, you've been, getting caught out after heads. There was one business, it was a much smaller business I looked at, where I was so keen to get the deal done, so keen to get the head signed and get my first one done before Christmas last year, this was. And then once we did sign the heads of terms, and then I started collating some of the financial information, which I had to wait a long time for, that's when the picture didn't start to look as good. And I then realised, actually, the business can't afford the earn-out structure that I'm proposing, or it can't afford the repayments on invoice finance that I'm looking at, once I then apply my costs as well to be running the business. So yeah, I think there's absolutely a lesson there in terms of taking that bit of extra time, using it to build rapport with the vendor, but at the same time using it to really, lift the bonnet up and get into the engine of the business and find out, right, how does this work? Let me understand how invoicing and credit control works. Have they been caught out before with anything? What is the cash flow like, most importantly? And building that picture, because it's ultimately going to influence your valuation. And, you said you've seen deals moved by up to like 4 million quid, which is a huge amount. And I think those conversations around valuation and price and how you're going to potentially shift that if anything comes to light are all best had as openly and honestly as possible, as early as possible.
Yeah, and then I think, my also experience is sometimes, even once you get to SPA, the accounts are such a mess that you can't get they just don't know. And typical things that would happen off would be things like invoice factoring. So they'll have invoice factoring on their accounts, and nobody's ever actually reconciled their balance sheet, say, to what the invoice factoring company think they owe. So you do that check, and I've seen that out by nearly $1 million. I've seen things like that out by $1 million, because it's just been years of accumulated. Now, uneducated buyers might not even know to reconcile those numbers as a buyer. So I've seen it where people haven't actually done those checks and they've bought the deal, and then afterwards it comes as a problem because they're like, why don't we have as much cash as we think? Because the materialization of the balance sheet doesn't happen because it was wrong in the first place. So you can check those numbers on due diligence, but let's just say you're 700,000 or £1 million out on invoice factoring. That could be a 9-month process to reconcile. So what does the buyer do? And I think it doesn't necessarily, if you, and in the end, this is why I think the deal is worth to the buyer what they think they can do with the company, because somebody might just turn around and say, oh, if it's £1 million out, there's just too much risk, I don't want the deal. But just because there's £1 million risk on the invoice factoring doesn't actually mean over a 5-year period that business isn't worth the money. The question is, can you sustain a potential cash flow risk in a period of time to build it up, and how do you negotiate the deal structure with the seller so that, depending on what happens with the output, which is where the earn-out clauses often come in, because the earn-out clauses would come in if you saw big material, things like that. So, that's why I think, as much as you can benchmark and you can say, oh, averagely valuations are going this, it might be that business is still worth a 3.5 times EBITDA, but they've just got cash flow problems because they haven't reconciled their balance sheet properly, and you don't know how many years that's happened over, because it might not only be the prior 3 years, it could be the prior 10 years.
Yes.
So we see things like that all the time. So I think that's why buyers also have to go in with a risk appetite of what they're willing to do, what they're willing to take on, because that will depend on how quick you decide to carry on or move out of deals, depending on the DD, I think.
Oh, absolutely. I mean, I like to try and get any of the deal breakers, let's say, out the way before you start incurring due diligence costs, in terms of, assessing as best you can on face value, management accounts, annual accounts, tax returns, looking at the cash flow of the business, operationally understanding the business, operationally understanding if there's any risk, commercially looking at, how the landscape is, and then all the other basic kind of, high-level DD stuff you'll ask yourself when you first look at a business. If it's a business with 5 charges registered against it at a company's house, that's going to start to raise some concerns that I'm going to want to look into. Whereas if there's no charges, there's no finance in place, there's no overdrafts, there's no debt, they're the sort of businesses that I have bought. Then you're quite comfortable then moving forward to heads of terms and starting to incur legal costs and accounting due diligence costs, because the risk of there being a deal breaker in there is a lot less. Whereas if you get to heads of terms quickly, and I've heard it described as trying to build a parachute once you've jumped out the plane, and hope that it's assembled working before you hit the ground. So you say yes to the heads of terms early, you then start incurring that cost, and you pray as you work through that and analyze the business that there's no deal breakers in there, because you've just incurred, tens of thousands of pounds worth of fees. So, I think, what I would always encourage people is do as much as you can to understand the business and make sure there are no deal breakers in there before you start incurring due diligence and advisory costs. But as you said, if there is something like that comes out of the woodwork, it doesn't necessarily have to be a deal breaker. It could just mean a renegotiation of the terms. Some extra protections need to be added into the SPA. It might affect the valuation. It's if there's levers in the valuation you can pull to adjust it based on what you've seen. If they're £1 million off on the balance sheet, that's significant. But all of these conversations are best had when you've got a good rapport built with the vendors. And you have that relationship where you can have conversations like that, and it doesn't get confrontational. It's not awkward. It's very open and honest. And that's something I've definitely learned on this journey as well.
Yeah, and that's one of the reasons. We're educating the sellers, because in the end, if the sellers for some customers now, we're actually doing sort of what we'd call dummy sales. So we're basically preparing the data room and as a third party sort of challenging those conversations, because in the end, if the seller just had all of the information and went to the data room and were commercially aware of their business and everything was fully reconciled, you wouldn't have the problem, because the seller would be, the problems only occur because the seller doesn't really understand the business, or that's a bit unfair, not doesn't understand the business, but maybe thinks the business is, they just know they're getting money in sales. Perhaps no one's ever financially audited the business or, you know, gone through in level of details that a buyer will go through, like when they come to sell. So if the seller actually gets all those things set up in place, then the deal will be quick, because ultimately there won't really be any questions, because there might be questions, but the information will already be there and they'll have a commercial sounding board. And this is why I just think, you know, where people are getting questions and they have to spend hours with their accountants to find out, in the end, these questions shouldn't take long to answer. If you understood your business and you had the information there, first and foremost, the questions would reduce, because you would already have the answers when you provide the information. And then the questions come back, it'd be quick to analyse.
Yeah, absolutely. I think that's one of the biggest things I've found since going on the business buying journey over, you know, because even though I left my corporate job in May, it started a couple of years ago, target screening and things. And I, as I mentioned at the start, you know, have written to thousands of businesses, have probably spoken to way over 100 businesses. And I've looked at, you know, visited and analysed probably around 45, 50 different businesses in the last, you know, couple of years. The biggest trend I could see in businesses that are below the level of being audited, which, what is it, 10.8 million revenue, I think, something like that. So companies less than that sort of size, where they go through an audit process regularly, the biggest trend I notice is sellers are just not prepared to sell. I've met with companies that don't have the management information to hand. They don't do monthly management reports. The accounts they've been waiting on for months, you know, the annual accounts they've been waiting on for months from their accountant, they haven't had it yet. There's no kind of management information in place at all in terms of just a simple organization chart. Don't have it. You know, can you let me know who your top 20 suppliers are? We're not too sure. We'd have to go through all the orders. You know, can you show me a P&L? Can you, any of that type of stuff? They just don't have it. So they're not ready to sell. I've met with businesses that have spent thousands to list with a small business broker. That's a topic for a different day. You know, but they don't even know how much they need for the business. They've not had that conversation yet. So they've gone into it kind of a little bit naively, just thinking people are going to turn up and make offers like when you're selling a house. Whereas in reality, you know, it does not work like that. And I think it's very telling of a business when you go to meet with them and you ask for, you know, let's be honest, basic management information, and they just can't put their finger on it. And, you know, it does slow things right down massively, because they're then waiting on bookkeepers, accountants, whoever to get that information for them. Meanwhile, you know, you as a buyer are getting frustrated. You're looking at other deals. There's other stuff going on. So I think, you know, putting myself into that situation, if I were ever looking at selling, I would make sure, you know, that data room is set up in that all the management information is up to date and gets updated regularly. You know, you're kind of looking at how transparent you can be with the business. So let's get our workforce model down onto an organization chart so they know who does what in the business. Let's get all our processes and procedures for the business documented. You know, let's do an audit of our purchase orders and reconciliation of the balance sheet, as you've mentioned, and just do all the stuff that you should be doing anyway. But if it's never been done, do it. Think of it as, I don't know, I've recently renovated my house. Let's say giving your house a fresh lick of paint and mowing the lawn before you put it on the market. You know, you're going to get a better valuation for it if it's looking good, you know, everything's presentable, than if it's not and you haven't done those things. So as a small business owner that's looking at it and going, I want to sell my business, but I've got a heck of a lot of work to do to give them all these things they're asking for. Well, if you go and do it, you're going to get a better valuation for the business, because they're going to see it's a well-managed business. Whereas if you're looking at a business from a buy perspective and they don't have any of this stuff available, the first thing you're thinking is, this is a poorly managed business. What else am I going to find when I start digging into it? So I think it's a kind of mentality shift that needs to happen for people that are looking at selling their business if they don't have all this stuff in place already. Yes, it's work, but the payoff is literally there for them.
Yeah, they'll get much better because and the biggest issue that I see is that, especially in the finance side of things, is they're not investing in the right people. So the amount of times I see probably businesses over 10 million where the finance manager, or whatever title they've got, finance director in some cases, isn't actually a qualified finance professional. Often the finance manager is the bookkeeper that first started with them 10 years ago and has just been promoted into that role, but they aren't really qualified and they've never they've never ran a finance department before. If you're going to get someone to head your finance department, you have to have someone that's ran a finance department before, because otherwise that person only knows what they know. So they'll only know as good as that. That's the biggest problem. And the problem with financial audits is they're regulated, but again, they're once a year and they're not really commercially driven. So, I mean, I've been into businesses where they've been audited and I found about 200,000 in the first day, because the financial auditors will only spot check. And types of things so it doesn't necessarily validate everything. So for example, I remember I went into a company that had been audited, and I sat down with the person that was doing the bookkeeping, and when I looked at their debtors, because this is what we call sort of three-way checks. So when you have like a three-way check, that would be something like a debtors or a stock, you've got three different ledgers that report different information that should all right. So on stock, for instance, you'd have a stock ledger, a general ledger, and then like a stock report as well, maybe from a front end system. And the question is, do all those numbers tie up? So I remember when we went into this one that was audited on the debtors, there's a front end system, which is like the debtors report, which isn't the general ledger. And it's the general ledger that goes into the accounts. The general ledger is what goes into the financial statements. And when they ran a report, it was something like 3 million out. There was a 3 million discrepancy between this one report and that report, but the audit had passed. So when I said, but no one was trying to actually manipulate it. No one was trying to like do this unethically. It was just because the bookkeeper was quite junior, but they were in charge of the information, and it was just always there. So it was just always there. And someone just hadn't asked for that report because it wasn't in the general ledger, it wasn't in the numbers, but it was a source report that should validate against the number. And I think it was like 3 million out. And anyway, in the end, we went through, and it doesn't mean that there was a discrepancy of 3 million in the general ledger, but you'd be asking yourself, why do they not match? Something in your process isn't working if you've got a 3 million discrepancy between that. And I see all the time. I saw a company once that had 7 million on their balance sheet due in wages.
Wow.
And you speak to the business owner and they go, oh no, it's okay, the account sorts it at year end. But I'd be thinking, but why does my system tell me I owe 7 million in salaries?
Yeah. Yeah.
You know, and the fact is they don't have the right finance department, because I understand that the owner probably doesn't look, and rightly so, because the owner shouldn't really be getting involved in the finances. But that doesn't mean that the owner shouldn't have the right finance department that is running those reports to not let those things happen.
Absolutely. I think what you've just described, you see a lot of in the small business world. You know, as you put it, the bookkeeper that started 10, 20 years ago and is now, just because of the length of time they've been there, you know, become the sort of finance manager, finance director, but they've never sort of had any experience anywhere else. They've not engaged in any CPD. You know, they're probably not on the cutting edge of development in, you know, the world of finance. Whereas in reality, it is actually quite fast paced. I mean, you know, off the back of the budget announced, you know, last week, I think it was, so much change that people are trying to get their heads around. You've then got technology as another, you know, market force, and how AI is being used, you know, new technology is being used to provide analysis, to streamline processes. So it's either a case of you can harness that and use it in your business, or you can ignore it and be left behind. But either way, I want a team of finance people that are one step ahead of me in terms of going, this is what we're anticipating. this is how as a business we need to respond. This is what the finance function of the business needs to do, how it needs to be configured to deliver the ultimate business strategy. And then in terms of technology and things, this is how we should be using it to make us as operationally effective as possible. Whereas if you are, no disrespect to them, but if you are a bookkeeper in a small business and you've never worked anywhere else and you've just kind of been lumbered with this responsibility, unless you're putting a serious amount of time into CPD and extra courses and networking and research, you're not going to know any of that. So I think it's vitally important, especially for business buyers taking over a new company, and you need to assess a current state rapidly and then adapt, create your future state design for the finance function. What needs to be true of this finance function to deliver my business strategy and get me to where I want it to be? And you have to have people in that business that can think like that on that level and provide advice. It shouldn't be the business owner determining how the finance department runs, especially if you're like me and you're not an accountant or anything like that. You need to be led by an experienced finance professional that can say, well, I'm the subject matter expert on this. I lead the team, I lead the function. We'll meet in the middle in terms of how business strategy meets finance function. There'll be reporting, there'll be regular meetings, there'll be discussion around how processes work. But ultimately, the CFO needs to call the shots in terms of the finance function. I've always been a believer in that.
Yeah. Anyway, you could go on forever and a day, couldn't we, about finances and the information. So we're coming towards the end now. I mean, what's next for you? I mean, it sounds like you're moving pretty quick. So what's your future aspirations?
Yeah, so like I say, I think possibly even next week now, by the looks of it, we'll complete on the second business. So that will put the group on around 8 million of revenue. We're bidding for some public sector work at the moment, so there should be some organic growth in that for us. So I'm hoping that by kind of Easter next year, we're over the audit threshold. We'll look to do another 1 or 2 acquisitions next year. I mean, now that I've sort of shown myself I can do 2 acquisitions in a year or in 11 months, definitely going to try and do another 2 next year, but hopefully slightly bigger, because I would love for the group to be at a kind of revenue level of about 18 million next year. Plan for me then, I'm going to continue to grow the Preventer group over the next 5 years. We'll then look to sell possibly a majority, but maybe a minority to a private equity sponsor. Obviously, I would de-risk and take some money off the table, would work with the private equity sponsor to then further grow the group and use their investment to, expand either internationally or into different sort of subsectors of the market. But ultimately, I want it to be a market leading company. I want to get on the Times, fastest growing companies list. And I think the way we're going from the organic growth we've had and the M&A strategy we've got, we're definitely on track to do that. So exciting times.
Oh yeah, sounds amazing. Well, thanks so much for coming on, Jamil.
Pleasure.
It's been great to hear your story, and I think it's really inspirational for people. So good work.
Thank you very much.
And No, you're welcome. And I just want to say thanks to our listeners. If you do like our episodes, do hit the subscribe button because it helps more people find our show. I look forward to seeing you again soon.